You're watching Business Today Television. I'm Sakshi Batra, and this is a special edition of Market Today where our focus is on the earnings front. The company on our radar today is the Pune-based product engineering services provider to automotive companies, KPIT Technologies, which has reported its stellar growth numbers in Q2. We've actually seen the revenue growth of 9% odd sequentially to 1199 odd crore rupees, but year on year the surge has been 60%. The net profit similarly has jumped 5% sequentially to 141 crore rupees, but on a year-on-year basis, there is a substantial 69% jump. Now, importantly, the company has also revised upwards the guidance on both revenue growth front as well as EBITDA front as well for the fiscal year 2024. For the full year of financial year 2024, the company now expects revenue growth of 37% in constant currency terms from the earlier guidance that was ranged between 27 and 30%. Additionally, the company has also raised the operating profit or EBITDA guidance for the year more than 20%. That was earlier in the range of 19 to 20%. Now, joining in to discuss the key insights from this quarterly earnings and the outlook going forward is the top management with me. Sachin Tikekar joins in. He's the President and Joint Managing Director of KPIT Technologies. Welcome, sir. Thank you so much for taking the time out for this discussion on Business Today Television. First up, congratulations to you for the strong set of numbers that have come about. What would you really attribute this performance to in an otherwise seasonally, quarter that has actually seen some of your bigger bellwether peers really report dismal numbers?
Thank you, Sakshi. Pleasure being on your show today. We are very happy with our H1 performance, including our performance in Q2. If you look at the momentum has been building up with our clients since post the pandemic. So it's been about 3 years of really good run. And if you let's look at what is causing all of this. One is the consumer behavior and standards when it comes to automotive and commercial vehicles, the standards related to safety and sustainability and consumer preferences related to services and ownership and stuff like that. These are the two factors that are driving change in the automotive industry. And OEMs are playing catch-up game to meet those demands. And that's why we are working on many production programs with the OEMs, essentially to help them make that journey from being a traditional OEM to what you will call a software-defined vehicle that can enable some of these services for the consumers, at the same time help them meet the standards regarding safety and sustainability. So it's we are sticking to our T25 strategy. That means we are working with 25 clients. Most of them, vast majority of them are OEMs. And we are working on programs that will go live, many of them in the year 25, 26, and some of them will go into year 27, 28. So it's a momentum that has...
Sure, sir. Sir, could you also tell us, what has really given you the confidence to increase guidance at this point in time when most of the top IT firms have actually cut their guidance? What are you doing differently or seeing differently among your clients?
What we have done is, again, I'll go back, about doing something differently is we've identified the pain points of some of these OEMs in terms of what is it that they needed to do. And we were slightly ahead of the curve. And we built those capabilities ahead of the curve. And now we are sort of helping them make that journey. And that journey is a 3-4 year or longer commitment from their side. So that's something that is working in our favor. In spite of certain situations related to macroeconomic or geopolitical things. And just the momentum that we carried forward from last year into H1 and the results that we have demonstrated in Q1 and Q2 gives us the confidence that to increase the guidance upwards, especially on the top line, and also increase the EBITDA guidance from, north of 20%.
Right, sir. So on margin front also, you have seen an expansion. What is the outlook, and would you be able to sustain these margins at these levels? Because, we've already seen the impact of wage hike, and despite that, you've actually seen a jump this time around. But going forward, the current quarter that we are in currently will also see seasonality factor play out, and in the end, again, you will also see furloughs happening in the December month as well. So how would you be able to sustain the margins on the guided front, sir?
So you're absolutely right, Sakshi. I think the wage hike, most of them happened in Q2, and now we'll have some promotions coming up, and seasonally it's going to be a slower quarter for all of us. Given that, we believe that the momentum that we have built in Q1 and Q2, the pipeline that we had, and the closures that we have had in terms of longer term engagements, it will help us to hold on to the margins that we have in Q3. And the effort is always to reinvest in technologies that solve problems of our clients. So the investment in terms of hiring the right kind of people and continue to build new practices and offerings to solve the problem. So investments in these two areas will continue during H2.
Okay. So since you talked about hiring, it's important to also talk about your headcount has also increased while most of your peers have actually seen a drop in the headcount numbers. In fact, we're staring at, news flows talking about how this could be the first time in 25 years when the headcount would have shrank for the entire IT sector. Tell us the true picture currently on ground, and what is your own outlook on hiring going forward, sir?
No, I think you made a great observation, Sakshi. Yes, that is the commentary that we are hearing from the IT sector. It's slightly different when it comes to ER&D. You've seen growth coming from most of the companies, some higher than the others, but there is usually the ER&D companies are more upbeat on the future than the IT companies. That's point number one. And point number two, as I mentioned, some of these programs are very crucial for these OEMs in order to come up with the new generation of vehicles in 25, 26. So it's very unlikely that they will cut any spend on these programs. And since we are part of these programs, we feel reasonably confident. Having said that, we are also very watchful of what's going on across the world, and we continue to keep our ears to the ground. It also has implications to your second point in terms of headcount. There is growth, and we need more people to enable that growth. Whatever plan that we made at the beginning of the year in terms of number of people to be recruited from campuses, as well as number of people to be hired laterally, we are sticking to those headcounts. We actually did that in H1, and we are sticking to the recruitment targets that we have in H2. So there is we are not changing our strategy in terms of recruitment.
Okay, but just a broader sense, sir, not just related to your company, but a broader sense from the industry, what would you really think are the key reasons behind the drop in, headcount? Is it more to do with the global slowdown that we are seeing, or does it also have a part of it perhaps due to the influx of more and more AI into the tech world?
Oh, absolutely. I think it's a combination, if you really ask me. There are growing uncertainties across the Western world, as well as you've seen some nervousness in Asia too. So corporates are, they're going a little bit tight on the budgets. That's as far as general IT and general industries are concerned. You've seen that across Europe as well as the US. Having said that, to my earlier point, that's not necessarily the case when it comes to engineering and R&D spend, especially related to automotive. Automotives in general have tremendous pressure because the transformation the industry is going through, and the traditional automakers have tremendous competition from some of the new players, both from the US as well as from China. So there is continued pressure. But for ER&D companies, we are feeling less of that pressure because we are working on something that is critical to them. So that's how I would actually differentiate the general IT versus ER&D and ER&D specific to automotive and commercial vehicles. If that answers your question, Sakshi.
Fair enough, sir. Let's come back to the earnings as well. I wanted to understand a little bit on the order book front. You posted a decline this quarter vis-a-vis the previous quarter. Why is that drop being seen? Is that a one-off? And what is the order pipeline really looking like for you?
Fortunately for us, the order pipeline has been robust throughout the year. It continues to be robust. Right now, we are not seeing any nervousness in the market. The order pipeline, to some extent, it changes from quarter to quarter, depending on the number of engagements that we actually sign versus the ones that are upcoming. So you'll see if you look at the last 8 quarters, you'll see slight up and down from quarter to quarter. That doesn't necessarily represent what the future is going to look like necessarily, right? So I think the guidance that we have given for the rest of the year, we are very confident about meeting or beating that guidance.
Okay, beating that guidance as well. So that could also mean that, you're just being like a little conservative with this guidance as well. We'll keep an eye out on this number as well. But also help me understand, the demand currently that you're facing, the client spend. What are you hearing from your clients at this point in time from your key markets? Earlier in the earlier part of this year, we actually were hearing that, there could be a hard landing, soft landing when it comes to the key markets like your US and Europe. Things have bettered off, but not completely out of the woods. But what exactly is the sense that you're getting?
Let's go region by region. Let's talk about US. I think US was supposed to get into recession for a long time, and 3 days ago there is a 5% growth, which is staggering at this point in time. So the economy is a little bit dynamic, so to speak. In spite of those numbers, there is general nervousness in the US that continues, right? So what you see in numbers, and then the field, there is a little bit of a different kind of a play there, and we have to be very watchful. And it will continue to be dynamic, given the fact that we have 2 wars. In general, there is nervousness that continues in a broad macroeconomic sense in US. Europe actually, however, at the same time, there are certain sectors that are still looking up. If you look at their growth, certain sectors have actually done quite well. So US is a mixed bag. Nervousness about future, but present looks solid. Europe is a little bit toned down, to say the least. The economy, because they're just very close to the action, right? Especially the geopolitical action. So there is a lot more nervousness in Europe, and you're actually seeing the growth has sort of declined over the last couple of quarters. And nothing is likely to change dramatically in the immediate future. So Europe is going to be tentative. In Asia, there are markets. India continues to do well. Japan, even though it's not a vibrant economy at this stage, but in our sector, the OEMs continue to spend money because they always take a very long-term view of their investments. So different markets are behaving differently. China, in fact, I was just there a few weeks back, and what you see on the ground and what you hear in the press is slightly different. In general, I think people are still optimistic in China. So, it's a mixed bag, to be honest with you, Sakshi. So that is general in terms of the macroeconomic picture. When it comes to automotive and commercial vehicles, like I said, OEMs are working to reduce their costs substantially in order to be competitive. However, they are doubling down on their investments towards what you will call software-defined vehicles and so forth, right? And we are just fortunate to be the beneficiary of that trend.
Absolutely. Well, it's been a great pleasure speaking to you, Sachin sir, and thank you so much for taking the time out to explain to us the insights from this quarterly earnings. All the very best to you for the coming quarters as well. And we shall definitely touch base again to understand more about the business and the industry too.
Looking forward to it. Thank you so much, Sakshi.
Thank you so much, sir. All right, and with that, we will wrap up this special edition, but do stay tuned on to Business Today Television for a whole lot more update from the world of business and stock markets.
Well, at the India Mobile Congress, really interesting propositions when it comes to new products and, of course, the technology of future is, of course, and one of the brands which I've been speaking to now is, of course, HFCL, the leading company when it comes to providing optical fiber and, of course, new network areas. Mr. Nada joins us. Thank you, Mr. Nada, for joining us, sir. What did Mr. Akash Ambani unveil at your setup?
We introduced